How do you use breaking news in your trading? Well, we're going to go over a couple of ways we look at it and if it actually disrupts our trading in any way. And we're also going to go over some ways we've heard other traders use breaking news to actually make money in the markets. So I'll let Padma start off with how you use it or how you don't use it.
I think that headlines trading is more for people like discretionary traders or semi-automatic traders because you need some intuition around it. The way I see it and the way that I've seen people use it is more around like mean reversion of impact. I think it's like you get an headlines that you expected to be let's say that it was an expected headlines, something like tariffs or whatever, and the reality of what's happening, what happens, or what is realized is much worse than what is expected, and you can like buy the reversion of that. For example, you have impacts on tariffs, right? You think that will impact the economy, that the economy will go into recession, whatever, and suddenly you start to feel that actually the administration is backing down on that idea, and the price and the market is completely mispriced to that, and you bet that they'll either fold on that or that it won't be as bad as it was thought it would be. So I think it's a real, like, the traders that I've seen made it successful are traders that are betting on reversions, like against consensus. Basically, everybody's wrong, and you take a position of the other side, even when it's extreme, like a very, a very big move that doesn't reflect reality. Have you seen other people use this type of strategies, Munir, in the past?
Yeah, I would agree for the most part. I'd say like it comes with the classic kind of sayings of, buy the rumor, sell the news. That's always a classic one. And then a bit more unattractive, not a nice way of saying it, but especially for war, especially with the Iran and Israeli war at the moment, is you normally sell the bombs and buy the bodies. That's the classic kind of Wall Street saying, at least for it. And I think most of the time, because the market is forward looking, you want to, like, as the rumors, like, buy the rumors, sell the news. Once the actual news happens, you normally trying to revert it, basically. And you're actually selling when most people are thinking, hey, the news came out, it's super positive, I'm going to start buying, etc. And you're kind of selling into them. It's especially very obvious with classic big events build-ups, like the Doge one back in 2020, I think, when Elon Musk was going to be on SNL. Everyone was buying it up towards SNL because it was going to be, is he going to mention it on SNL? Is he going to do something around Doge? And then once the actual SNL, episode released, everyone just sold into the news, and that was the kind of the best way to actually do it. So I think if you're discretionary, you can definitely do great strategies around it. I think if you're systematic, there probably could be some ways. I definitely know at least some hedge funds must run like algorithms based on selling and buying the news and trying to interpret the sentiment of it as quickly as possible. So I definitely think that is out there and actually being done. I just don't think for most retail traders that'd probably be a strategy that's worth it. I do actually have one interesting story from a futures trader I knew back I think it was like 2 years ago, give or take. What he used to do, which I found crazy, and if you're happy to take on risk, it can be something you may want to do. But for the most part, what he did was that when he knew news was going to come out, such as, I don't know, CPI, Trump's going to talk, whatever, he would place a limit order 2 standard deviations away from price on both the upside and on the downside. So if it was on the downside, he would sell, and on the upside, he would buy. And pretty much once that news came out, either one of those orders is going to get filled, and then he would try and capture as much of that move as possible. Now, the key risk there is that news isn't always interpreted correctly straight away. So you might get some news that initially comes out. I think this actually happened with Trump's, where I think everyone believed it was going to be just 25 or something like that % tariffs. And then he brought out the card, and then that card had all the crazy tariff rates. So initially you saw ES and NQ jump by, I think it was like 1% or 2%. So if that theoretical trade, he placed that limit order, he would have been in really solid profits. But once that news had kind of developed, let's say, or matured, that completely reversed and would have it would have been a huge loss for him. But I know he made a very decent amount of money with it. It's a very risky strategy, but it's those sort of things you maybe could do as a retail trader if you're wanting to do something that's a bit more, I don't know if you'd call it degenerate, but it's pretty risky.
Yeah, I think it's about like selling big deltas of expectation versus reality. For example, there's headlines that you cannot predict, right? A COVID type situation, you cannot predict that comes out of nowhere, and maybe you can make like a bet, like, oh, this will be nothing, or whatever, or the Fed will recover the market, whatever you want to do. But there's headlines that come out of nowhere, and that's a risk tail. But for example, you have, like you just said, around earnings, if you have something that is expected, but it's surprisingly very positive, you can maybe play momentum there in the reverse. And the same way, if it is whatever expected and there's a large deviation from what was expected, and you can bet against it. I think it's very much about like your intuition and interpretation of the news and what kind of impact it should do. Like we were talking on this podcast when the tariffs came off, that we were buying the S&P on the way down because we didn't believe that. It's not that we knew, it's just we were betting on the man, like trying to make an estimation of what we would do in the future. And as soon as Trump started folding on the tariffs or making them less than what they were, the market started recovering. And I do think that's the for the retail trader, you really have to go against massive consensus or on massive deviations from expectation, in my opinion.
Yeah, I definitely agree. I also think it was for this Israel and Iran one, you know, I saw someone put an Excel model up where they were like, it was basically just game theory of like what would happen, right? It's either nuclear war happens and you bought SPY, well, now you're all dead and there's no market, or everything's completely gone to zero, or nuclear war doesn't happen, things get resolved, and you've just bought on like a crazy, you know, good dip of the market selling off. And now, like, if you're applying leverage to that or you're trying to perfectly time it, then yes, that's going to cause issues. But on a discretionary side of things, like that, you know, that's just a plus EV, at least in my head, that you could just buy that and it's going to be most likely rebound within a couple of months. And, you know, it's been a bit crazy over this weekend. Actually, this leads me into the second topic I did want to talk about, was that if enough people are relying on something to be true, it normally makes it false. So like a lot of times this weekend, everyone was assuming, including myself to some part, was that, you know, this Iran war was going crazy. There was headlines every second. There was a new bomb dropping every second. It was just insane. And everyone thought SPY was going to, you know, completely gap down this morning. It was going to be, you know, minus 2%, minus 1%, etc. But it's, you know, completely different. At least at the time recording this, is up, I think, like 1%, which is pretty insane for everything that's going on. Now, obviously, there's been new news that have come out that they want to de-escalate the position. But that is a very classic sign of how, where if everyone thinks something is going to happen, there's a very high conviction, at least from my experience with markets, that it's going to probably be the other way.
Yeah, for sure. It's like I'm like, as you were saying, I remember my Ethereum trade. So this is all public, right? We are not here hindsight warriors. Like, we have everything posted and we talk about it here on the podcast. So it was around early April. So Ethereum was like down almost 70% from the top. And I bought it around 1.5K. I posted it on Twitter back then on leverage. Then the trade didn't went well. I covered too soon. But the idea was the same. Like, everyone was hating on Ethereum. The entire market, the crypto market was up. Ethereum was down 70% from the highs. Everyone was saying that no one was going to use it. Like, it was negative beyond negative. I saw that and I started scaling into the position. I actually caught the bottom, but I was prepared to buy even lower. And yeah, after a few weeks, right now, where we are, it's at 2.6K, almost 70% up from the bottom. And it's the same play always. It's like fading the general consensus and having the courage to go against it.
100%. I think one thing that's, I guess, is actually a downside of automation is I sometimes lose touch with that sort of I guess whatever you'd say, intuition or whatever, of just the classic saying of, you know, you're buying the fear and selling the greed. When everyone's very fearful of something, oftentimes there's great opportunities, especially for buying. Now, the only thing I've noticed, I don't know if you'd agree, is most of the time when you are buying fear, you're going to have to withstand a decent percent drawdown for a decent period of time. It's very rare that you like perfectly time it.
Oh, for sure. It's the classical mean reversion play. Like, if you are going to play mean reversion setups, right? If you are correct on your assessment of pricing, let's say that you are, that something is deviated from what it should be priced at, you will, the more the position goes against you. So, for example, if you are taking a long position, the more it goes against you, the stronger that signal gets. right? Because it's a mean reversion play. So the more that you go into the drawdown, the stronger that signal becomes. Obviously, there's caveats, and you shouldn't hold it to zero, right? But the idea is that the position strength grows higher and higher, the lower it goes. And like, for example, on the hyper liquid trade, when I was buying it at 9 or 10 or whatever, I said on the tweet when I tweeted about it that I was willing to bid even lower, that I was doing a multi-month position. Like every month I was going to buy a stack of hyperliquid on the way down. And I was prepared to go another 50% drawdown. It is the reality of that trade.
Yeah, it's a very scary one. Luckily, you timed it very well. I was so surprised how well you timed it, but definitely that is the thing I think a lot of people get wrong is when I see people try and buy fear, they'll slap on 50x leverage or something crazy, and that's just going to be a losing time. You most likely you won't be able to withstand it unless your timing is just incredible.
Yeah, you have to be prepared to scale into that trade. In terms of you shouldn't go to an infinite loss, of course. Again, that's not viable. But a mean reversion play, you either very accurate on the position and you get it right away, or you're going to have to scale into it, and it's going to be difficult.
Yeah, 100%. One thing I actually wanted to quickly touch on, and I wanted your opinion of it, is I remember we were talking about it off the podcast about why discretionary losses suck way more than systematic losses. Do you remember like what was the main kind of quote we were talking about with it?
So my idea, why is it better, is because you cannot, like, you have nothing to look forward to. Because if I take a loss on my systematic model today, I know that I'm still trading with positive expectancy. It has nothing to do with my trade. But if I'm doing a discretionary trade, I could have just thrown money out of the window because I don't really know if what I did right now is really as positive expectancy to the best of my ability,
Yeah, that was it. Perfect. Because when you said that, I never had really realized it or had put it as clearly as you said that's why discretionary trades that I've taken in the past and sometimes here and there always suck way more if I lose. I always thought it was because I felt a bit stupid for taking a discretionary trade, or like, oh, why did I take that? I could have just stuck to my systematic trades, etc., or put more allocation to them. But I think when you said that, it was a lot more clearer to me because we take losses all the time. I've taken many losses, and especially in futures. But it doesn't really matter because I'm always thinking about the next, 100 or 1,000 trades, that are going to be placed. But when you're doing discretionary, all your attention is normally on one trade, and there normally isn't another one that's going to be set up to follow that you're going to instantly be able to take, or that you're going to be looking forward to, or something like that. A lot of the reasons why I'm systematic is because of conviction, and I think so much of trading is just conviction based. Like if you're convicted about something and you have a very high degree of certainty, or you're very confident in it, most of the time over a long enough horizon, you're probably going to be fine. Like you'll probably make some money here and there from it, as long as it's not a completely ridiculous bet. But in systematic trading, that was very doable for me because I could look at back tests. I could, look over a large sample size. Like that gave me a lot of conviction, which made me able to stick to my strategies, or, see them run and not have to turn them off because they went into a drawdown. But every time I was discretionary trading, if I took a losing trade, then I just didn't feel confident on any of the next trades I really took.
Yeah, because the future is more murky, right?
Yeah.
The future is always murky in trading. You don't really know if we have edge into the future, or edge can decay or whatever. But at least in systematic trading, you have a path. You understand why you took this loss. You can track it. You can measure against benchmarks, whatever. But if you are trading completely discretionary, you don't. You could have traded with a positive expectancy or not. You don't know unless you are very good at it. But that's a different case. It's the same as winning the lottery. I think it's the reverse psychology, because if you win the lottery, I don't think that you'll be happy. You'll be happy when you win it and maybe change your life and buy Lambos or whatever. But after a bunch of time, most people feel like imposters because they didn't earn it. Most of them spend it all away. On the other hand, if you make like $10 million as a business owner, like you built a business from scratch with your own hands, the processes, you made systems like to really make the business efficient. And every business owner that you ask, could you do this again if everyone took everything from you? And they say yes, because they have a system, they have a process. Like they don't feel like imposters because they built it from scratch. And I think it's the reverse. It's like having that idea that you don't know what the future looks like. And I think that's the psychology of why it hurts more to lose as discretionary than systematic, in my opinion.
Yeah, no, I think you summed it up perfectly. Do you want to go over your last topic about practitioners?
Yeah, sure. So today I saw a tweet which I found it very interesting. It's like a guy saying that he sees all of these quants like writing articles on complicated math and whatnot, and at the end of the day, that you have a guy like that doesn't even know a math formula that is making way more money than these quants will ever do. And it's true. Again, I want to make the caveat that there's some brilliant minds in like high frequency trading, market making, and I'm not talking about those people. That those are brilliant minds, but the so-called like how can I say, like aspiring quant traders, most of them don't even have a dollar at stake. You know, it's like they are academics. They don't trade because trading is hard and difficult, and it's for practitioners. You will only get good at this game by practicing, not by elaborating mathematical equations or reading books, just by getting in the order book, if that makes sense. We talk a lot about that.
Yeah, no, I agree. I think like it also is kind of like a very similar topic to where most people just want the outcome. They never really like they want. How do I put this in a more clear way? They think that the more complex the solution or more unique the solution, the faster the outcome's going to come. Like I get so many requests of people being like, "Oh, could you do a machine learning project for futures markets or something?" Right? And I'm like, my first question is, why machine learning? Like, why is that the thing you go to? And most people just kind of toss it up to being, well, that's the most like, sophisticated method. You're using tons of data points. It's going to be super, highly predictive and shit. And it's just so hard for that to actually work. I'm not saying it doesn't work. There's obviously many funds that use machine learning, but as a retail trader, for you to get that up and running, no overfitting, no issues, etc., it's just, in my opinion, like not worth the work most of the time. And you
No.
can often find way better solutions that aren't going to make you as much money. Of course they're not, but they're going to be more reliable of what you could actually trade and actually get going and then start, actually making some money. And then you can go on from there. If you want, maybe in the future, you can try and do some machine learning, but it's just a bit ridiculous that most people see sophistication as the best outcome. And also, I think also a lot of things, I don't think, maybe it's the way trading is presented to many newcomers, especially I guess it was presented to me in a similar way, is that everyone just thinks it's fast money. Everyone thinks if you do the complicated thing, you're going to make fast money, you're going to make a ton of money. Most of the time, it's just not like that. Most of the time, you just have to withstand boring drawdowns. Most of the time, you have to backtest a lot of strategies. Most of the time, you have to dumb things down. Most of the time, you have to fix infrastructure issues, all this sort of stuff. Like that's none of it's fancy or fun, but it's actually like what would make you money over the long horizon. And it'll probably not be as much money as you're assuming, but the compounding does catch up. It's just most people think you're going to be making a million with some crazy ICT strategy.
You know something that's so funny. I'll use a real world example for this. It's like sometimes you see those how can I say, like consultants or people that work in offices with ties and suits and seem so fancy on their Mercedes and stuff like that, and then you find out that your family member that is a plumber or an electrician is making multiples of what they do at a year. And I truly think that is an industry like that. I think that life is like that. This is not fancy. It's just like most of trading is just boring most of the time. It's just managing things that you don't like, that you don't want. It's frustrating. It's not fancy. Maybe once in a few times a year, yes, it's amazing. You make a big a ton of profit on a trade that went well, and it's very dopamine, But most of the times it's just like doing the same processes, coming every day, doing the boring thing every day, keeping systems in check, making sure that your exposures are not running wild. It's just boring, man. And it's like the fancy guys that you see using maths and stuff, most of them are larpers. They are not doing anything, they are not trading. So yeah, always remember that, in my opinion, like a trader is a boring business, making a service like any other stuff. If anyone comes to say otherwise, like they are trying to sell you something, man.
Yeah, I would agree. Like the only thing I find hard with that is like I don't think we find it I don't think on a daily basis we find trading boring. Like I love talking trading, that's why we do this podcast. It's more just like, I bet LeBron or whatever somewhat enjoyed his practice rounds, but it is also, doing thousands of practice rounds. Like it becomes mundane, I guess. It's not as flashy. You don't wake up and you're like, oh wow, I'm so excited to do this one piece of code. But it's not like I'm hating life while coding. I'm hating life a way more if I was a bartender again or something when I was a kid. Like those sort of things I actually really did have no enjoyment of, really. But like doing this is just it's a very nice life, but it's just not what people I think advertise it to be, with some flashy sort of life.
Yeah, don't get me wrong. Like, I wouldn't trade it for anything. That's why I do. I could be easily doing like a business, any other business, in my opinion, and I could do well. I think you too, Munir.
Yeah.
Pretty easy. I'm just saying that this is not like you see in the movies. Like, you take $10 million and you're gonna bet on this opportunity that you see the housing market crash, and you're gonna take like a gigantic position. No, most of the times it's boring, doing the same thing every day, like repeated, like you said, mundane, the same like basketball thing. It is what it is. And reading documentation, doing code, building code, dealing with problems, and that's it. It's not, in my opinion, real trading is not a big flashy life. And usually those big flashy traders that you see on social media, either they made it and got lucky, and okay, they are flashy, whatever, good for them, or they are just living a lifestyle that is not real.